Hi everyone, welcome to today's discussion on tax deductions. At the end of this lecture, you should be able to describe the meaning of the terms tax deduction, also known as a write-off, taxable income, adjusted gross income, and how deductions affect your taxable income, and some common tax deductions. Let's get started. So the IRS quickly is the government agency. It's called the Internal Revenue Service that is responsible for collecting taxes, investigating tax fraud, and prosecuting tax evaders. Now, you don't have to worry too much about the IRS. For every $1 it spends in investigation, the IRS typically recovers about $14 in unpaid taxes. This is one of the arguments people make for having more IRS agents investigating tax fraud. It can be very lucrative for the government to pull in that extra tax money that people aren't paying. The average recovery from a tax fraud is $50,000 in unpaid taxes. So for most people, you may not pay anywhere near $50,000. So they're not coming after people looking for, oh, you are off by $100 here or there. They're looking for people who are massively underpaying their taxes, and they're investigating those people. All right, tax deductions. A tax deduction basically decreases your taxable income, which lowers your tax bill. So up until this point, we've been talking about taxable income and how it's almost always less than what you really make. And the reason for this is what's called tax deductions. The government uses tax deductions to try to encourage certain behaviors. For example, there's a mortgage interest deduction, which means you can deduct the amount of the interest you pay on your mortgage every year. This encourages people to purchase a house rather than rent. And the government feels that that's a beneficial thing for the society, so they have a tax deduction for that. Your taxable income is called your adjusted gross income, or AGI. So when you see that term, adjusted gross income, they're just referring to the amount of income you have after deductions. And this AGI is the actual amount of money that you run through the tables and calculate your income tax with it. Not your actual income, but your adjusted gross income, your taxable income. So this is a great video for some tax deductions. Let's give it a watch.
What's this? Looks expensive.
This is some new bedding.
David, didn't I just tell you to save your money?
Yeah, I am testing this out for the store, so work is paying for it.
Work is paying for your bedding?
I was gonna leave, but now I don't want to. So.
What is that? Is that a new lamp?
Yeah, I'm thinking of bringing homeware into the store, so that's a write-off.
That's a write-off?
Yeah.
Do you even know what a write-off is?
Yeah, it's when you buy something for your business and the government pays you back for it.
Oh, and who pays for it?
Nobody. You write it off.
Who writes it off?
I don't know. The write-off people. What? Why are we having this conversation?
So if I need booze to get through my day, I can just write that off?
That's a stretch.
But the skincare products you got this morning, those are a write-off.
What skincare products? You purchased skincare products?
Okay. I am the face of the company. If I have acne, what does that say about the legitimacy of the store?
That's not a write-off. That's not a write-off. This? Not a write-off.
Oh, well, the bedding's non-refundable, so...
David, a write-off is a business expense used to reduce your taxable income.
Okay, well then, why isn't it called a tax write-off?
It is! It is! You can't just buy things for yourself and write them off.
Well, then I'll return some things. There's not enough space in here for the massage chair anyway.
I should get back to work, just in case any more of your packages arrive.
So yeah, that's a good example of what tax write-off or tax deductions, same thing, definitely are not. So some of the things that you can have for tax deductions are some medical and dental expenses, not all, but some over a certain level. Some charitable donations. So you might hear somebody say, hey, I donated some money. I'm going to use that as a tax write-off or a tax deduction. And you can do that for some donations. Home mortgage interest rate, interest. So any interest you pay, not your actual mortgage payment for principal payment, but any interest you pay, you can use that as a deduction as well. In your first few years of owning a home, that can be a substantial amount of money that you're actually writing off on your taxes or deducting in your taxes. Interest on student loans is another big one. Any state and local taxes. So if you pay the state, Washington State, like your property tax, you can actually deduct that from your federal taxes, so that same money doesn't get taxed twice. So there's a typical philosophy out there that we only want to tax your money once. So if one government agency is taxing that money, then it's not taxed by another agency. It's not always true, but it's typically true. You can also deduct sales tax and state income taxes, which we don't have in Washington State, but some states do. To do sales tax, you have to keep all the receipts. It's a big nuisance, but it can add up. My advice is you make big purchases like a car or maybe furniture, something where there's hundreds of dollars of sales tax. It would be a good time to hold on to those receipts and see if you can use a deduction. Some personal losses from natural disasters. It's one of the reasons that having a disaster declared is important. That opens up this. Sometimes if you lose your property is damaged, you can deduct that from your income tax. And some business expenses. This is what David was referring to here with all the things he bought that were all just tax deductions. Even if it is a tax deduction, it doesn't become free. You're just not paying tax on that money. So you still are paying a majority of it. It just helps you a little bit. All right, let's take a look at how this works. So Margaret is single and made $87,500 last year. She paid $700,000 in mortgage interest and $3,500 in medical expenses. Let's assume that those two deductions are okay to use. So together she has a total, let me turn this on real quick. She has $7,000 plus $3,500 for a total of $10,500 in taxable income, in deductions, I should say. And she made $87,500 last year. So all I do is take the $87,000 that she made last year. This is her actual income, and we're going to subtract away her deductions. So $10,500. And what that's going to equal is, it looks like $77,000. So this number is her AGI. This is her adjusted gross income, her taxable income. Now let's look at how this would affect her taxes. So over here, before deductions, let's say she made the $87,500, right? So here's her money before deductions. Let's put that, the first $10,000 goes here. So we're going to put $10,000 in there, and 10% of that is $1,000 in taxes. Now from 10 to 40,000, so this is $30,000 in this bracket. It is and 12% of that is $3,600. I don't know if these numbers agree with today's. These might be older numbers. Just don't worry about that too much. This is just showing you the effect of the tax write-off or the tax deductions. And then, so right now we've gotten $40,000 of her money placed. We still have $47,500. So we're going to do $47,500 in this last bracket, which it fits in easily. And to do that, we're going to say $47,500 times 0.22 for 22%. And that gives us a taxable income of, a tax for that one, $10,400. Is that correct? Yep. We'll assume it was correct. All right. And so here, this is, looks like $15,000. Well, that's nice and round. So we have a $15,000 tax bill without deductions. Now, if you do deductions, so when you do deduction, I shouldn't say if, you have $77,000 of AGI. So basically, this first one's exactly the same. $10,000 here, $1,000 in tax. This next one's also the same. So $30,000, because she still has enough money to fill this one, $3,600. Now the next one is, instead of $47,000 left over, we're at $40,000. We have $37,000 left over. So that goes into this one. Then when we do this last calculation, you can say 37,000 times 0.22, and that's $8,140. So here I'm going to say 8,140. Notice the only difference here is in this top tax bracket, because she reduced her income by $10,000. This number is smaller. So she ended up saving just over $2,000 in taxes. So here we take this and it's 740, 11, 12, 740. So $12,740 in taxes. So $10,000, a little over $10,000 in deductions, only saved her just over $2,260 in taxes. So you don't get the full money back for deduction, you just get the taxes that you paid on that money back. All right, hopefully that's clear. Whoops. Oh, this popped up all at once, sorry. So taxable deductions reduce your adjusted gross income. Essentially, they hide a portion of your income from the IRS, so you don't pay taxes on that part of your income. You do not get the entire deduction back, only the taxes you have paid on that money. The result of this is that higher income households benefit more from tax deductions. So for example, a married couple making $900,000, that's a ton of money, who has $30,000 of deductions, because they're in that 7th tax bracket, they're going to be getting that 37% of taxes they paid back on that money. So if you look at $30,000 times 0.37, 37%, they're going to find a savings of $11,100 on that $30,000 deduction. Again, they don't get the entire deduction back, just the taxes they paid on it. Now, a similar couple only making $90,000, that's pretty good money, making $90,000 a year, who has the same $30,000 in deductions, they're only going to save 12% because they're in the 2nd tax bracket, not the 7th tax bracket. So their savings is only $3,600. So the same deduction for both these households is going to be $8,000 less savings for the lower income household as opposed to the higher income household. So this is one of those times when it's kind of backwards feeling, like the people you want to help the most are getting the least help, although deductions are good for everyone. All right, my friends, have a great one, and we'll see you soon.